Here on set with us in his first interview of the year on his 2026 outlook is Oppenheimer's head of technical analysis, Wald. First of all, great to see you.
You as well.
Second of all, forget the fundamentals and earnings. Forget it, Ari. You look at that chart. What does it tell you? When are we hitting S&P 7K, Dow 50K, and all the rest of it?
Well, we put out our big numbers for 2026. Our top number was S&P 7,700. We think the market continues to push higher. And it's really just a case of there's very few market top warnings as it stands today. We think the cycle is intact. If you look back historically, 8 out of 23 cycles since 1932, bulls have made it this long.
But when you say there's no signs of us topping out, talk about that, because that's what everyone's on the lookout for.
Yeah, and the cycle has matured. We're the fourth year now. We should be getting close to this topping point. But when we think about internal breadth, we have the Russell 2000 now actually pushing through resistance that has capped gains for the last 5 years. I think that supports a healthier, more inclusive advance. Look at market leadership, high beta cyclicals outperforming defensives. We got credit spreads hitting new tights for the cycles. So the typical warnings that you would see into a top just aren't present as we currently see it.
Because a lot of people would say this is just, not that it's gone too far, it feels top heavy, all the gains are at the top and so on and so forth. So along with seeing the S&P being able to keep going to 7,700, what else do you see based on everything you're watching? Like what else, is it broadening? Is it different kinds of sectors that you see taking the leadership?
It is. It's the broadening trade. And granted, there is no middle ground here. I mean, as it stands, if you look back historically, either it's another double-digit gain or you top out and you're negative. So we're just going by what we see right here, right now, which is the rebroadening trade. This is not a sell big tech trade. It's the fact that now industrial stocks, financials, small caps, probably most importantly, are starting to break out to the upside. World stocks, probably the biggest chart I had with global PMs last year is the MSCI All Country World breaking through 18-year resistance dating back to the great financial crisis. But if you look at it, that subset versus the S&P, I still think this is a tech-led secular bull over the long term.
What could break it? Anything that you're seeing in the charts that's like a little bit of a warning flare?
And that's the key. The specific cycle-ending catalyst always changes. Tighter monetary policy, economic recession, runaway inflation, bursting of an asset bubble.
Criminal investigation. The chairman of the Federal Reserve.
But you're looking for the market's reaction, and the market warnings historically have remained the same. Narrowing breadth, defensive leadership, widening credit spreads. Even as we think about interest rates. In our view, it's neither high nor low rates, but stable rates that support a healthy market, a healthy economy. We've had a range-bound 10-year for much of the last 3 years. If that starts to nosedive lower, we start to see leadership turn more defensive. That would worry me. We're not seeing it.
Yeah, well, sounds good. See you later. Have a nice year. And, because I think we're all trying to figure out, like you said, there is no middle ground. So if the options are, and again, we can always buck historical trends, but that we tend to either keep going or face these kind of negative returns. And then to Brian's point, trying to watch the market behavior, because we've seen sell-offs on headlines. I mean, look what happened last April. That looked like it was a break from the rally, and yet it wasn't. We dropped significantly, and then I'm talking about the rally since 22, right? We dropped 20%, and then we marched back and kept going.
Yeah, volatility is the cost of admission for long-term price returns. You have to expect it, even in positive years. We look back midterm years that are typically strong, especially in the second half. Still, the average of max drawdown is 10%. So expect volatility. Actually, if you look at those midterm years, May to September in particular, the weakest stretch of that. So it could be setting up for another sell in May. That does set up for the sweet spot of that presidential.
That's not a bad thing, though, right?